Hey everyone, Coach Investor back on our earnings video for today. So let's talk about Lemonade. Lemonade reported earnings yesterday after the market closed. At the time of making this video, the stock is up around 12% pre-market. Quite nice, and even nicer, it's up around 40% since their lows at the end of July. So quite a nice little Lemonade squeeze there. Now in this quarter, we're going to have a look at a lot of crucial and important quotes and numbers because the path to profitability is there. They're also going to have an investor day later this year, which we're going to cover on this channel. Of course, let me know if you want to do a live stream. Let me know down in the comments below. If you're still holding Lemonade as well, let me know in the comments and what you think about this quarter. But overall, I don't think Lemonade ever missed a quarter. They either met or beat and raised, which is pretty nice if you ask me. Now, obviously, if you just look at the stock price, you think the business is dying. But in reality, it's far from that. Now, before we go and look at that, if you want to support this channel, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to full.com/couchinvestor and make sure to check out all the other links in the pinned comment. So first things first, the highlights. In-force premiums grew 54% year over year to $558 million, beating their own guidance. Premium per customer grew 18% year over year to $290. Total customers increased 31% year over year to 1,579,936. Gross loss ratio is still extremely high at 86%, but it is down quarter over quarter. Again, we're going to have a talk about that a bit later. Gross earned premium sits now at $107 million, and that's up 60%, also beating their own guidance. Now, they are giving us here an in short and in full explanation. So we're going to have a look at the in short first, and then I will touch on some specific things I thought were interesting in this quarter. So they say your top and bottom lines came in ahead of expectations, like we've seen above, but this is more interesting. Cross sales trended up. 23% of sales in Q2 were from cross sales and upsells, which means no extra spending to get more money from a specific customer, which is great. Loss ratio trended down. They say here, as I said, it's down quarter over quarter. It actually improved 10% in 2 quarters. Okay, we're going to have a look at that a bit more because they are talking a lot about loss ratio and their models, etc. So we're going to have a look at that. Now, path to profitability. This was very interesting when I read that. So their customers and products continue to season. We expect returns from earlier investments will soon outstrip cost of new ones. Accordingly, peak losses are expected this quarter, Q3 already, and EBITDA is expected to improve thereafter through profitability. So that's very, very interesting, and I don't think a lot of people expected this quarter, well, the quarter we are in now, so Q3, to be peak losses, which means Q4 will already be a much better one. Now again, this is a double-edged sword, this type of announcement, because if something bad happens and Q3 is not peak losses, then you can expect obviously the stock to get crushed. Now I know one of the questions on Say was whether they needed more cash, if they need to raise more cash and dilute shareholders, etc. So they're saying here, we've moderated our growth spend and hiring pace and expect our existing capital to suffice until we're profitable, which is again something that is very, very nice to hear, but they did touch on that a bit lower down the line here. Now, before we go and look at that, Metromile acquisition closed, as we've seen before. In return for approximately $145 million in stock, we received a business with over $155 million in cash, over $110 million in in-force premium, a second insurance entity with 49 state licenses, and data from 500 million road trips. If you ask me, this deal was a bargain. Now, when it comes to profitability and fully funded, etc., they talk here about the $5 gallon. So this is really a story, basically, about miles per hour driven or miles per gallon driven. So at first, miles per hour, that's when the price of the fuel, let's say, is cheap. So you can refuel en route, you drive the speed limit, etc. and you get there pretty much sooner, right? As I say here. But when gas is $5 a gallon, you do well to slow down to 50 miles per hour. I don't know what the speed limit is around the world, but slower than before. So you're going to optimize for miles per gallon. You're going to spend less on gas. You're still going to get to the point you need to be, but it's just going to take a little bit more time, but less money. And so they say here that's the change they've made in response to the sharp increase in their costs, gas costs in this story. They've shifted from optimizing for miles per hour to miles per gallon and expect to make the journey without needing to refuel, meaning not needing to raise more capital. Now I'm skipping some stuff, talking a bit about Metromile here. So they have onboarded about 80% of Metromile staff in recognition of the synergies the deal offers. So what happens to the other 20%? Well, they got laid off, cutting costs. That's normal in the current environment. Now the closing of the Metromile transaction changes their product mix significantly. Renters now comprise about 1/3 of the book, down from almost half, while car jumped from 1% to 20% overnight. Now they do say that until they can offer a unified Lemonade car experience, they expect to spend little to no marketing dollars on acquiring new customers to Metromile, and that's why they anticipate car to represent a somewhat declining portion of the book in the second half, giving the natural churn inherent in the business. Now this will also affect a little bit the loss ratio, but overall they said it's not going to affect the goal for EBITDA at the end of the year, which is great to hear. Now as for cross-sells and upsells, you can see here a nice uptrend there, percent of sales excluding car that were cross-sells or upsells. Again, this just improves the value of one customer without needing to spend more advertising dollars. And as you can see right here, in Illinois, where they rolled out car already for a few quarters, 36 of all Lemonade sales in Q2 were cross or upsells, and annual dollar retention was 93%. Now 93% is exactly what I want to see for the overall business. Unfortunately, they're not there yet. Now when it comes to loss ratio, they talk about a thing called lifetime loss ratio. They're talking here a lot about their LTV6, which is their new lifetime value machine learning model, the 6th generation, basically how it can analyze and predict what a particular customer is going to cost them in the long term. Churns, premiums, claims, etc. All of that gets calculated. This is the 6th version. They're going to talk about that in November in the Investor Day. Obviously, they do say that this one is much better than the last version, etc., etc. And this is why they're already seeing in their models that the overall loss ratio for the last 2 years, so the customers that joined the company 24 months ago, are becoming a bit more profitable, which you can see on this graph that they give us right here. Customers' loss ratio tend to be the highest early on. In their experience, it takes 2 years on average for a customer's actual loss ratio to intersect their lifetime loss ratio. Thereafter, their losses tend to be lower than their lifetime loss ratio. So let's see what happens in the coming quarters, and maybe that's why they say that Q3 will be peak losses, because they already anticipate this to happen. And last thing about the lifetime loss ratio, so this is what LTV6 prediction looks like for each cohort that they onboarded in the past 18 months. As you can see, Q1 2021, 85.7%, Q2 2022, 68.4%, much lower than their own projections, which was to stay below 75%, which in my opinion was still too high, so I do like to see a number under the 70% there. Now, when it comes to reinsurance, there has been a change. Some of you might know it. As of July 1st, 2022, they're ceding 55% of gross premiums to the same program that they had before, but that's down from 75% when they started, which means they're starting to step down the percentage they cede as their business grows and diversifies, lowering their book's volatility. They plan to gradually reduce the portion of premium that they cede over time, which means more money for them. Now, I do know that this video has been going on for a while, so I'll try and keep it as short as possible here. So ADR is now at 83%. Last quarter, it was 82%, so a little increase of 1% here, still far away from the industry average of 92 to 94%, so there is still some work to do on that front. When it comes to operating expenses, that increased $18.8 million to $86.9 million, but it is down quarter over quarter from 92.5 in the last one. So it's nice to see a decrease in expenses. Yes, an increase year over year, but a decrease quarter over quarter. Now, when it comes to net loss, so net loss was also a bit less than last quarter. By the way, this surprised a lot of people, especially on Wall Street, a loss of $1.10. I believe the street were expecting a bit more than that, and this is also an improvement quarter over quarter. The same goes for adjusted EBITDA loss, $50.3 million. Last quarter, that was $57.4 million. And now, as always, everybody is very interested in total stock-based compensation. So that sits at $13.9 million, also a decrease quarter over quarter. Now, when it comes to guidance for the next quarter and for full year, I start with the full year. They do expect in-force premium to be a bit higher. This is including the impact of Metromile, which in the last quarter was excluding that. So now in-force premium to come between $610 and $615 million, gross earned premium between $476 and $480 million, revenue to come between $236 and $239 million, and then adjusted EBITDA loss between $245 and $240 million, stock-based compensation expense of approximately $60 million, so that remains unchanged, capital expenditures of approximately $10 million, that's down from $14 million, so again, very, very nice to see that. And as for next quarter, they expect, and this is also including the impact of Metromile, beginning July 28, in-force premium to come between $595 to $600 million, gross earned premium to come at the midpoint of $128 million, revenue $64 million, adjusted EBITDA loss $72 million, and then stock-based compensation of approximately $16 million, which yes is an increase quarter over quarter, but this is probably because this is including Metromile. So overall, I know this video has been on for a long time, but again, this is a crucial quarter for the company, so I do take a bit more time to go over these reports. And I'm pretty happy with how the business is doing. Obviously, they still need to continue to execute. The risk is not off the table yet. Let's see if they can continue in the next coming quarter to decrease the losses, improve profitability, continue to grow, not burn excess cash, and I'll be very, very happy. Obviously, we're going to have a summary, let's say, of the Investors Day in November. And if you want a live stream, do let me know down in the comments below. Share your thoughts in the comments as well. If you enjoy this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. And I'll see you all in the next one. Bye-bye.